Hey everyone, in this video I'm going to compare Palantir Technologies with Advanced Micro Devices, AMD, and answer which one I think is the better stock to buy. Coming into this analysis, I had both of these stocks rated as a buy. Now I'm going to determine which one I think is the better one to buy if you're choosing between the two. So let's jump in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the first metric I'll compare these two on is revenue over a trailing 12-month basis. You could see AMD is 10 times bigger compared to Palantir in terms of revenue, 22.68 billion in trailing 12-month revenue, and that's increased nicely over the last 3 years. Palantir has also increased its revenue nicely over the last 3 years up to 2.2 billion, and as we'll see a little bit later, analysts expect Palantir to grow revenue at roughly 20% per year. The next metric I wanted to compare these two on is operating profit margin, and they seem to be going in opposite directions. Palantir's operating profitability is soaring up to 5.39%. That was up from negative 100%. Palantir has made excellent progress improving profitability. The company has done an excellent job controlling costs while revenue has increased. They've been controlling costs in all the right areas. If you've been watching my videos on Palantir, you'll hear me commend the management for increasing spending on research and development while cutting spending on corporate areas that are not directly connected to its core competency. I was happy to see what Palantir management has done in terms of allocating costs efficiently. AMD, meanwhile, headed in the wrong direction, although I would expect this to improve meaningfully over the next 2 years. AMD suffered from the change in consumer spending. Remember, people bought a lot of computers in 2020 and 2021 when they were spending more time at home, learning from home, working from home, entertaining from home. And then as economies reopened, people returned to school. People had all those computers now. They didn't need to buy any computers in 2023. And so AMD's business really suffered in 2023. Inventory built up not only for itself, but for its channel partners. And so now it's correcting that. And as it will benefit from demand from AI, its profitability will return as consumer behavior normalizes. So AMD not in a good spot in operating profitability right now, but it's expected to improve going forward. In fact, Palantir over the next 2 years expected to grow revenue at 19.5% and 20.4%. Meanwhile, its bottom line is expected to grow by 18.1% in earnings per share and 18.2% over the next 2 years. So not only has Palantir made excellent progress on profitability, that is expected to continue for the next 2 years at the very least. However, AMD is expected to demonstrate better profit expansion, with 18.3% revenue growth expected in 2024 and 47% earnings per share expansion expected in 2024. 2025, 18.5% revenue growth expected, with 37.5% earnings per share growth. So AMD's profitability is expected to grow at nearly twice or more than twice the rate of Palantir, at least over the next 2 years, where we have analyst estimates from Wall Street making this prediction. Similar to its operating profit expansion, Palantir has done an excellent job improving its cash flow from operations. Look at this massive improvement up to 32.01%, eclipsing AMD in this metric, surpassing it and taking a huge lead here while AMD has moved in the wrong direction. Again, just like operating profit margin, I expect AMD's cash flow from operations will turn upward starting around the second quarter of 2024 and continue moving in the positive direction. For now, however, Palantir way ahead of AMD, 32% compared to 7.35%. I also wanted to compare average diluted shares outstanding. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. All right, so now that you understand why shareholder dilution is important, you can see they've both done a similar rate of increasing shareholder dilution, with AMD doing a little bit more than Palantir, 32% in the most recent trailing 12-month period compared to 29% for Palantir. They're both diluting shareholders. AMD just a little bit more than Palantir over the last 3 years. And lastly, I wanted to look at the price to earnings forward ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. Okay, so now that you understand the importance of this valuation metric, you can see that Palantir is trading at almost twice the valuation of AMD. Palantir is trading at a forward PE of 61.36 compared to AMD, which is trading at a forward PE of 31.36. Now, while AMD did demonstrate better growth prospects over the next 2 years from Wall Street, Palantir demonstrated better growth in operating profitability and better growth in cash flow from operations. However, Palantir didn't demonstrate to me clearly that it deserves this roughly 2 times premium valuation. I do believe it deserves a premium valuation over AMD, but not nearly 2 times the valuation premium. So if I was to choose between one of these two AI stocks to buy today, I would choose AMD. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.